Friday, October 29th, 2021, Monaco 64, home of alternative economics and contrarian views. So are central banks losing control of the bond market? I think they might. And we have to go all the way across the world, down under to Australia. It looks like the Aussie government bond market is imploding, or at least yields are rising very sharply. And some of you might know that when yields rise very, very sharply, it means that investors are selling their bonds. Then prices go down, yields go up. It's not a good thing. And why do I say central bankers might be losing control of the government bond market? Well, because in Australia, they had a policy that they had instituted, the Reserve Bank of Australia, that they would control the yield of the 3-year government bond. At the time, it was the April 2024 government bond, and it still is that. And if you don't know what yield curve control, I recommend you watch a video I did in February of this year. It's called Yield Curve Control Might Be Tough to Implement in the 21st Century. Because yield curve control, it's the next step after QE when the central banks feel reluctant to continue to do QE, because with QE they create reserves. That's what money is called when it's created by the central bank, and it stays in their balance sheet. They create really reserves out of thin air to buy the bonds to keep the yields under control. And why do they want to keep yields under control? Well, because they want to keep the everything bubble going, because bond yields set the price of every other kind of investment, be it stocks, be it real estate, be it anything that has a financial flow to it, because government bonds, and especially U.S. Treasuries, are supposed to be the risk-free rate of return. So we've heard from the bond deflationists, those who think yields will never go up. They say that there's a glut of savings, but they look at savings as stock market investment, bond investment, and they don't look at savings in the old sense of the word, that savings really is when you have real money put aside, that is gold and silver. And the reason why they give this excuse of excess or a savings glut is that they want people to believe that rates are low, not because the central bankers are manipulating it, but because people are flush with a lot of savings. Do you see people around you flush with a lot of savings? The only reason it looks like there's a savings glut is because the value of stocks and bonds have been inflated out of all proportion by the money printing by the central banks. So you can bet when yields continue to rise, be it in Australia, be it in the UK, be it in the US, be it in Europe, the value of people's savings are going to collapse and yields are going to go through the roof. It's going to look the European sovereign debt crisis of 2011, 2012 look like a picnic. It's going to be a global sovereign debt crisis. And I think Australia is just the first domino to fall. I could be wrong, but we need to keep an eye on Australia. So what is going on in Australia? And it's been happening the last couple of days. Well, it says here, abc.net.au, Australian website, RBA waves white flag on bond yield target. So interest rates may rise sooner than expected. Well, they're rising already. abc.net.au. We've even had here in the UK yesterday, Barclays, HSBC, NatWest, TSB raise mortgage rates just hours after the budget. So it's not only in Australia, the major banks in the UK are raising interest rates. So yeah, as I said, they had this target of 0.1% yield for the 3-year. So now I'm going to show you where the 3-year Aussie government bond is. You can see here earlier this year they were able to keep it around the 0.1%. And the thing with the yield curve control, the central bank has to have credibility. The market has to believe that the central bank will defend that 0.1%. And how do they do that? Well, they defend it by buying that bond if the yield goes slightly above that 0.1. But as you can see, they've lost total control of that 0.1% level. This is the 3-year government bond yield for Australia. I don't have a chart for the April 2024 bonds. That's more like a 2.5-year bond. But apparently that one, they've lost total control of it. It was around 0.1 up until recently, and now it's above 0.5. But as you can see here, even this 3-year yield here, it went up to almost 130, and it's gone from below 0.6 a couple of weeks ago, middle of October, all the way to 1.3. So they're losing control of the 3-year. They're losing control here as well, even though they weren't implementing the yield curve control on the 10-year bonds. You can see that 10-year yields now in Australia are above 2%. They're the highest since, well, the beginning of 2019. This is a post-pandemic high. So this is not good. And just to show you what the FT is saying about this morning, Australia refuses to defend bond yield target, signaling QE shift. Decision raises expectation that country could raise interest rates as soon as next year. And some of you might say, some other people might say, yeah, it's all going to be under control. They're going to raise rates. But the way the market is reacting, having worked in the bond market as a government bond broker for over 20 years, doesn't bode really well. It's not a smooth move here in Australian yields. So let's have a look here at this article, quickly go through it and see what the people in the markets are saying. The Reserve Bank of Australia refused to defend its bond yield target, a pillar of its quantitative easing program, unleashing what one trader described as carnage in the country's sovereign bond market. So it's not me being like hyperbolic. Even a trader in the bond market is saying it's carnage in their bond markets. And I think it's all about faith and confidence. I think bond investors are losing faith and confidence in the central banks. And the main reason for that is the rising prices, what people normally call inflation. But inflation, of course, is the increase in the supply of money and credit that we've had in spades for 13 years. And now we're actually seeing rising prices of consumer goods, of commodities, and central bankers haven't done a thing. So the bond vigilantes seem to be out. And as I said earlier, I think this could be the first domino to fall in the bond bull market, the bond bubble. It is the biggest bubble. The bond market is much bigger than the stock market. But let's continue here. Markets pushed the yield of the April 2024 Aussie government bond to more than 0.7 on Friday, blowing past the central bank's targeted level of about 0.1% after the bank opted not to intervene. Well, why didn't the bank intervene? Well, because it's a losing battle for the central bank. The market has lost faith and confidence in the central bank. Yields move inversely to bond prices. Australia is the second country this week to abruptly halt its bond buying program after the Bank of Canada surprised investors on Wednesday by signaling a shift to tighter monetary policy. The RBA's decision comes amid growing anticipation that it could raise interest rates as soon as next year. The Reserve Bank of New Zealand raised rates for the first time in 7 years this month, following moves by Norway and South Korea. The RBA's decision not to intervene sent shockwaves through the country's sovereign bond market, with yields on its 10-year bonds jumping 11 basis points or 0.11 percentage points to 1.95%, marking their highest level in 2.5 years. Well, I think the FT is kind of behind the curve because we went up to 212 this morning, so it's getting even worse than that. The RBA simply doesn't show up to defend their yield target. The bonds are slaughtered, one fixed income trader said, also describing the latest moves for Australian, New Zealand, and Canadian bond yields as massive carnage. Quantitative easing is becoming unglued, and it's very messy, he added. We will see how long the Fed and the ECB can hold out. So that's the key comment there for me in this article. Analysts had predicted the RBA could officially drop its yield targeting program as early as next Tuesday, when the central bank's board is scheduled to meet. David Plank, head of Australian economics at ANZ Bank, said the central bank's decision not to intervene was implicit confirmation that it would abandon the program. They've obviously decided not to bother making the effort today, given that on Tuesday they're probably going to announce an end to it anyways, he said, adding that a stronger than expected reading on consumer inflation, well, consumer prices, right, published on Thursday had helped to force the RBA's hand. The consumer price index reading published this week showed core inflation, the central bank's preferred measure. Well, that's the one that doesn't add any food and energy, of course, breaking into its target range of 2 to 3% for the first time since 2015. I think the normal CPI is more like 4.5 or 5 in Australia. Economists at Bank of America Securities forecast this week that the RBA would begin raising rates in the fourth quarter of 2022. In light of today's data, that points to a faster, more sustained rise in inflation. It had previously said the bank would hold rates until late 2023. So there you go. So why can't the central bankers just continue to do more and more QE, continue to create all these reserves, these trillions of reserves out of thin air to keep bond yields low? Well, because the cat is out of the bag. People are realizing that yes, the consequence of inflation is here. We have rising prices, and they're not going to stop. The problem is for the major central bankers, especially the Fed, the ECB, the Bank of England, and the Bank of Japan, and also the RBA, is that the whole system, financial system, the whole economy of these countries are based on cheap and easy credit. The whole stock market, bond market has been levitated because of these low rates. Yes, it's not going to be pretty once they start raising rates, once they stop QE. Everything is going to implode. Are they trying to do this on purpose to bring, to collapse the system and bring central bank digital currency? I don't know, but for whatever reason they're doing this, it might be this, but I think it's more the fact that the bond bull market that we've had for 40 years is just turning. Yeah, I think those people who are still expecting lower yields going forward, those people who still expect deflation, they're going to be proven wrong, and we're going to see the biggest bubble in recorded history. And it's not cryptocurrencies or Shiba Inu coin. No, it's the government bonds, the bond market bubble. It's the bubble that sustains every other financial bubble, because the bond market is really where the price of credit, money and credit, is set. And if this price is going to rise, all these other financial assets, their values are going to implode. So when is this going to happen? I don't know. It could happen very quickly. We've never been in this situation before. I know we've recently reached all-time highs, or we're near there in the stock markets, and they can keep it going for longer. But as I've said, I want to stay out of the system as much as possible. I'm going to hold on to my real money. Yes, gold and silver, because if there is an implosion of the government bond market, like we saw, it's possible. We saw in 2011, 2012 in Europe. We almost saw the Italian government bond market, the Spanish, the Irish, the Greek, the Portuguese bond markets all collapse. We saw yields go to double digits. But at the time, Mario Draghi, who was president of the ECB, still had some ammunition. He threw everything at it, right? And he started buying those bonds. But I'm not sure the central bankers have the ammunition, because it's not just about saying, oh, we're going to do more QE. We're not going to let the bond market collapse. It's about having credibility by saying that in a economic environment where inflation is raging, where commodity prices are going through the roof, where there's shortages, where there's backwardation, where people want real things. Yeah, I think they're losing control. We're going to have to just sit tight, be patient. So with that, let's look at where the markets are this morning. It's 8:45 a.m. London time. So we've got spot gold at $1796.30. It's down $2.50. Range has been 1801 to 1792. Spot silver is at $23.90, down 16 cents. The high's been 24.11, the low 23.77. The Dow futures down 52. NASDAQ is down 115 points. S&P is down 18. The FTSE is down 8. To the currencies, we've got sterling down slightly, 137.88. The euro is down about 0.1 versus the dollar at 116.68. The dollar is unchanged versus the yuan at 113.56. And the dollar is slightly lower versus the Chinese yuan at 638.60. You would think that the Aussie dollar would be having trouble, with the bond market having trouble, but right now it's pretty stable. We're at 75.44. The dollar is down slightly versus the Canadian dollar, 123.42. And the Kiwi dollar is down about 0.2% at 71.87. To the commodities, we got crude up about 0.2% at 82.47. That's WTI. We got high-grade copper down about 1% at 438. We've got natural gas up 0.5% at 581. To finish off, let's look at the U.S. 10-year yield. Well, that's up 3 basis points at 160. It looks like the U.S. government bond market is still under control, unlike the Aussie government bond market. But one thing that we've noticed, of course, is that the shorter end of the yield curve in the US is starting to move up quite quickly. We're seeing the yield curve invert quite a bit, which is a bad sign for the Federal Reserve. So if you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Rumble, Twitter, Facebook, and all these other platforms below here. I wish you all a great weekend. Take care. Bye.